everyone. Ideally, the internet stays stable today. Realistically, yesterday got cut off, but I pretty much finished what I wanted to say. Markets, large downside momentum does continue, and I'm going to give you guys a few reasons why I don't necessarily think that the lows are in, but we might be very close to lows. A lot of people are running for the hills talking about this being the large market downturn that we're seeing, and we're going to see like a cataclysmic move to the downside, right? All this, all that. And this is the start of a massive correction. Now, there are a few factors. Realistically, we're still a very strong upside market where equities are green year to date, right? NASDAQ and the S&P specifically. And we're in an election year. Now, yes, of course, we still have the potential causation of this large downside, quote-unquote, recession that's being talked about based on the Fed's activity, right? The Fed cutting rates in this specific market environment and what's going on can lead to medium-term to longer-term downside in the equities. Typically, when we see yield curves inverted, right, we have the 2 and 10 year that's been inverted for a very, very long time, a few years now, and we're seeing the Fed's funds rate along with the 2-year, right, larger divergence. The Fed's funds rate is now above the 2-year, that's dropping off. And every time that we cut rates, when we're in these kind of market environments, you do see a significant downturn in the markets. So short term, that rate cut is going to be pretty bullish, right? It can span into and after the election, but we're most likely going to see some downside from there. Now, one of the things that I'm looking for is some kind of bottom in these markets so we can see a multi-month rally, either testing all-time highs or maybe even making new all-time highs. But I don't see larger capitulation in these markets just yet. One of those readings is based on breadth, right? The breadth in terms of the S&P and the NASDAQ, you can see from these colorful lines, hasn't reached extreme lows. This is one qualifier that helps me look to actually pick up and find bottoms, which comes into place, right? That the bottom in this market isn't necessarily in my opinion. And I think that we don't have too much to go, but we've got a few rotations that might happen towards these lows before we see that kind of bottom. It's kind of rare to see one singular day just push things up super aggressively rather than some kind of formulated bottom that tries to rally prices. We've had multiple gaps on the way down, and the way I see this is if we can go and fill that gap towards that like 528, 530 on the S&P 500, that's going to create a lower high to push us into a new low, and then we start looking at some kind of more capitulative movement. We've still, even though we've seen very significant downside, we've still seen predominantly kind of controlled selling, not like crazy capitulation, and a lot of the tech names that have been battered, realistically, they've been battered pretty aggressively, have seen a single day rally that was pretty expansive from yesterday. So since 2020, right, not 20, I was going to say 2022. Since 2020, Google finally received a direct hit from the U.S. Justice Department in a legal suit over its search and text advertising businesses, and a decision by the U.S. District Court Judge Amit Mehta ruled that Google's exclusive search arrangements on the Android and Apple devices reinforces dominance and effectively blocked search competitors from succeeding in the market. And it means that the tech giant violated Section 2 in the Sherman Act to become the world's dominant search engine, and Google's currently controls about 90% of the online market. Google is a monopolistic, and it has acted as one to maintain its monopoly, said Mehta, that wrote in a 276-page decision. As an example, Google shelled out $26 billion in revenue share payments in 2021 alone, which was nearly 4 times more than all of Google's other search-specific costs combined. And the deals gave Google default placement of its own search engine at partners' keys search access points, and its partners also agreed not to preload any other general search engine on the device. So this is like one of the big from the Magnificent Seven that I think all of them are under scrutiny by the Justice Department, the U.S. Justice Department. But a lot of the tech names, like as I was mentioning before I took a look at that, a lot of tech names yesterday did try to find a little bounce, right? Google pretty much cleared the gap that was created before kind of pulling a little lower. I think that, again, a lot of these haven't necessarily bottomed, but they're seeing extremely oversold movement, which is the biggest drop that we've seen this year in a larger trend. Generally, like around the 200-day average in a strong bull market isn't a bad place to be picking things up, right, for the longer term. But you can see like all these, like Google, Amazon's below the 200-day average. Nvidia is another one that's seen a very aggressive rally as of recent, pretending to create some kind of a bottom. But as these big tech names get sold off, right, we've seen that Warren Buffett has shelled off a lot of money out of Apple, right? I think they've cut their position down to like 50% holdings this year alone. And a lot of these swings they did get picked up yesterday, and they're starting to create what looks like some kind of a bottoming formation that could take a few weeks to expand, right? But I don't necessarily think going all into these positions and expecting a multi-rally after this is the right way to go. So a lot of this was based on Japan's Nikkei, which actually ended up the overnight session, pretty strong today, right? You can see from the lows yesterday, from the lows all the way up to the highs as of recent, we're up about like 15%. It's down currently. We came into this area just for it to get slapped back down another 5% from that high. But the Nikkei had a very, very nasty session, followed by a very good session, making it its best session since 2008, following a 13% plunge on Monday. And it doesn't look like it's necessarily over. Yeah, sure, okay, it ended up pretty well, but there's still some weakness in this. Much of the volatility is said to emanate in Japan, where a carry trade based on the yen went sour as the BOJ raised rates during the same week the Fed signaled its intention to cut. So over in the U.S. market, stock index futures are rebounding this morning. Volatility, the VIX, right, soared to pandemic levels yesterday. It's pulling back a bit. I think that we're in a topping area of VIX. I'm not a volatility expert, nor am I going to pretend to be, but I think that an expansive VIX at 65 seems very outlandish based on the drop that we saw yesterday. But that also means that if we see 60, 70 again on the VIX, don't necessarily be surprised, which could be caused by some more downside momentum, meaning that I think we still top around 60 to 70 on the VIX realistically, and we can look for short volatility from that area over the coming weeks. But trying to like get short volatility right now, based on what had happened yesterday, might be a bit touchy. So note that there were some S&P winners during the wipeout session yesterday, which also saw the yield curve uninvert for the first time in 2 years. So in terms of some of the other news, what we have, data dependency. We're seeking to reassure investors the Federal Reserve officially chimed in on the market's mayhem. San Francisco Fed President Marley Daly said the monetary policy is clearly working in the way intended, and it's still too early to determine if there's real weakness in the labor market. Friday's jobs number data did not indicate a recession, added Chicago Fed Austin Goolsbee, and we shouldn't act or react to one number, and we should always be forward-looking, he further explained, noting that there's no recession despite the yield curve being inverted for 2 years and uninverting. So the last time we saw the Fed talk about this, shit hit the fan pretty hard. So I think we're in a rocky position in these markets. I don't necessarily think that it's going to be sunshines and rainbows as we've seen for the past 2 years. We're entering into a rocky period, but I think this like super aggressive pullback is going to be undone over the next few months, but I don't think it's going to be a snapback matter of time where like everyone just like piles in long and we look for 7,000 on the SPX, right? My personal thoughts. When we look at the market today, the S&P 500, the futures, I am looking for a little relief rally bounce. The way that this market is extremely oversold like this, I think that there is, like on the overnight, there was some intention for the dip buyers. There's a very specific level at 51.95 that people have to keep eyes on. That's going to be a key barrier and pivot on the day on these futures. And realistically, above 52, like 60, that's where the buyers would want to kind of come in yet again. And I think 53.20 to 53.35, that's going to be my main upside target to see if we can reach those areas for that relief rally bounce for bigger sellers to come in. I don't necessarily think that we just continuously hammer the sell. I could be very wrong, right? But that happens based on if we're above or below the 5260 to start things off. So let's see how this shapes up in our live trading. We're going to open that up. One of the big things to mention is like these are very, very volatile periods. A lot of people that might be watching this or are trading right now, maybe seeing it later, you might not have even seen 60 VIX like when you started trading. Some of you are seeing 60 VIX for the first time. So NASDAQ for me is untouchable. The spread alone on NASDAQ, I take like a 5 point hit pretty much the second I get in, so I don't touch that. The S&P, I'll be trading smaller size, right? And if I want to trade multiple lots, realistically, I might be trading maybe like 15, 20 micros rather than 2 lots on the minis because I want to reduce my size because I'm increasing my stop, right? My stop has to be 4 to 6 points on the S&P alone. I know some people that are trading with a 10-point stop on the SPOOs and are trading with a 50 to 70-point stop on the NASDAQ. So you have to adjust your risk based on the volatility that the market is trading at right now. Rule number 1. So let's open up our live trading room. Let's see how today cooks. And we had some crazy moves so far to start the week. Over 100-point swing on the S&P from yesterday's close into last night. And we'll see if we can replicate that today, baby. So let's open up our live trading room. I'll see you guys in there, and we shall do this again tomorrow. So thank you, take care, happy trading. Remember, manage your risk way more than you normally would in these market conditions. Don't get screwed in this market, right? It's a very tough market to trade.